Welcome everyone. Welcome everyone to our last seminar of the season. It's great to have you. So before we actually go to the seminar, just to repeat our announcement, we do have the new call for papers for the fall. The deadline is June 26, 11:59 Pacific time. So that's in about a month, no, exactly a month from now. And please do submit, and we hope to see you next year as well. But now we are very pleased to have Paige Rowberry with us, and she's going to talk about whether market fragmentation improves price efficiency. Anna is also here, and she would help with the chat questions. So we're going to have breaks at about 15 and 30 minutes through the talk. So unless you have burning clarifying questions, please hold them until the breaks, or feel free to put them in the chat. And with that, Paige, the floor is all yours. Thank you.
Great, thank you. Okay, today I'll be presenting, does market fragmentation improve price efficiency? This is joint work with Jonathan Brogaard and Anne Haubo Dyhrberg. Okay, to begin, we know that the trading of a single security across multiple platforms, known as market fragmentation, is a defining feature of modern financial markets. In fact, before the year 2000, the New York Stock Exchange and NASDAQ handled over 95% of US equity trading volume, whereas today their combined market share is now less than 35%. And the same phenomenon exists in Europe, where the listing exchange accounts for only 40% of the volume share. But despite this persistent and widespread trend, the effect of fragmentation on price efficiency remains mixed. So this leads us to the question that we're going to be answering today, which is, does market fragmentation improve price efficiency? Specifically, we'll be pulling from a recent theoretical work from Chen and Duffy 2021, which shows how increased fragmentation can actually improve price efficiency. Now, the way in which this works is their theoretical model links price efficiency and market fragmentation through price impact avoidance. So first, imagine that there's one centralized exchange. And in this one centralized exchange market, a large order would face a steep price penalty, such that the larger the order that the trader is submitting, this escalating cost would discourage informed trading. Now, on the other hand, in a more fragmented market, this allows traders to divide orders across venues. And with more venues to split orders across, traders can split up their orders such that they're able to reduce their aggregate across exchange price impact. Now, with these lower cross exchange price impacts and lower execution costs, traders will trade more on their information and thus impound more information into prices such that price efficiency can increase. Now, I'll walk through these three sort of cases so that we're clear on what we mean when we say that the recent theory suggests potential benefits from increasing fragmentation. Okay, so scenario one, imagine that there is one centralized trading market. And what's going to happen here is if the trader were to submit one large parent order, this order would execute fully on venue one, because there's just a single venue in this market. And what would happen as a result, as you see here in red, the trader would face the overall larger price impact such that this would reveal the information against the trader and move the price. Okay, now let's consider scenario two, which is, suppose there are now two separate venues, venue A and venue B, but the prices are perfectly correlated across these two venues. Now, here in this scenario, the trader can split her order across these two parent venues. So here you see that she starts with her one parent order and she splits that into two child orders. However, if these two venues, venue A and venue B, are perfectly correlated, then prices would instantly update after submitting on, say, venue A and venue B, such that there would be no benefit to this order splitting across the two venues. Because although there are two venues in this setting, if the prices are perfectly correlated, there would be an instant spillover. Okay, now for setting 3. In this scenario, independent venues can make order splitting valuable. So here again, we have a trader who is wanting to submit a parent order that she splits into 2 child orders. But here, if there's imperfect correlation between the 2 venues, then it will take longer for the second child order to execute before the price is fully updated on, say, venue B. And as a result, from splitting her orders across these 2 venues, she can face a lower total overall price impact than she would have in the scenario where there was only 1 venue or where there were 2 venues that were perfectly integrated such that the market operated as one single venue. Okay, now to test this new theory, we leverage cryptocurrency markets. And we do this for a few reasons. The first is that in cryptocurrency markets, there are separate order books. There's no centralized routing mandate and no consolidated best price. And consequentially, this leads to some differences in prices across venues where there's not this rapid cross-market integration like we would have in equities. And using this cryptocurrency setting allows us to test the predictions from Chen and Duffy for price efficiency and as well as for price impact avoidance. Okay, so what do we find when we test the predictions of the Chen and Duffy 2021 model? The first thing that we'll show is in our cryptocurrency setting, when a venue is removed, trading access is removed from a major trading venue, we show that fragmentation decreases. And as a result of this reduction in fragmentation, a few things happen. So the first is that price efficiency decreases. And secondly, we find that the mechanism behind this price efficiency decrease is consistent with a reduction in the ability of traders to split their orders across venues. Specifically, we find that when fragmentation is reduced or one of these venues is lost, we find that the price impact increases. And we find that the effects are going to scale with shock size. And furthermore, we find some, albeit weak and limited evidence that reduced fragmentation also raises trade size. We don't have a perfect proxy for trade size, which I'll get to in a moment. But overall, the evidence supports the order splitting channel in Chen and Duffy by showing that when we reduce fragmentation, this can actually improve price efficiency. Okay, now for the data that we use to answer this question, we leverage TARDIS.dev data, which has both trades and quotes from March of 2021 through May of 2023. And in total, we pull from 16 centralized cryptocurrency venues with electronic limit order books. And we use over 1,700 unique spot coin pairs where we exclude derivatives and non-spot type contracts. So again, we're just focusing on spot coin pairs that are traded on one of these 16 centralized cryptocurrency venues. And then what we do is we aggregate our measures from the venue day level to the coin day level. And we do this so that we're able to test the effect of price efficiency and price impact avoidance across exchanges at the level of the coin. Now, to measure these things, we compute fragmentation as 1 less the HHI of daily dollar volume for these cryptocurrencies. And we measure price efficiency. Here we take the price efficiency principal component from autocorrelation and variance ratios. We capture these measures from the 1-minute horizon up to 30 minutes. And we sign these so that they're increasing in efficiency when we examine this price efficiency principal component. Similarly, we compute the principal component from price impact measures at 4 different horizons so that we have one aggregate measure for price impact. And then we'll include average trade size as well. What we're going to do when we use these measures in our cryptocurrency setting is we're going to explore two different shocks to fragmentation. The first of which is the collapse of FTX. We use this because it's a market-wide shock. It affected a wide cross-section of coins at once, and it was a sudden venue closure that allows us to explore what happens when a venue is taken out of the market and there's one less trading place through which fragmentation could occur. Secondly, we're going to use Binance delistings. Now, contrary to the FTX collapse, the Binance delistings are coin-specific. It didn't apply to a whole venue. And what we'll do is we'll examine these repeated coin removals to see what happens when coins lose access to a single venue. Okay, now this brings us to our first question block.
Yeah, I have a quick question on so the shock which you're FTX, because Bitcoin, I mean, these cryptocurrencies don't have idiosyncratic information. That's a big information, right? That the exchange is collapsing, there's counterparty risk. So it may not be a very clean event in that sense, right? This is not only defragmentation, but also new information about the risks in the coins. Don't you think
You're right.
so? I mean,
Yeah, you're right that this is definitely a bundled shock. You're right. It doesn't only impact fragmentation. It also led to market-wide stress. You're right that that's a concern. When we get to the empirical section, I'll show you how we try to account for that by building an appropriate control group. But you're right that that is a legitimate concern in the FTX setting.
oh, okay, I'll wait then. Okay, thank you.
Let me come back to that question.
So I'll
Can I
use
ask
my
a question?
moderator prerogative and I'll ask a question.
Paige.
So I actually have a question about the choice for exchanges, because you're saying it's centralized, but this is not all the exchanges, right? What happened? Why are you not looking at the decentralized exchanges as well, especially with the shock to FTX, when many of the coins, because people kind of lost trust in centralized exchanges and custody and would have shifted to the DeFi. So it's kind of, in terms of what happened to fragmentation, we're not sure unless we know that chunk as well. Is there a reason for just centralized?
Yeah, why don't we focus on these decentralized? We focus on centralized because they're more comparable to the equity market. Yeah, we haven't tried looking at the decentralized as well, but that's a fair question.
Can I ask a question?
Yeah.
Yeah. So in equity markets, right? So we have price priority across exchanges, but we don't have time priority, which means that there's a possibility that fragmentation can in fact increase consolidated debt, because you could have that you could essentially skip the queue, right? So if two exchanges are quoting at the NBBO, then I can quote at one of those two exchanges, and there's no time priority across these exchanges. Is it right? So so I don't know much about cryptocurrency markets, but I'm wondering if that does not apply to cryptocurrency markets.
That is a good question.
Can you have trade throughs in the cryptocurrency markets?
Can you what?
So can you have trades? So can you have a trade on an exchange that's quoting a worse price as compared to another exchange?
Yes.
Right. So in equity markets though, right? So like you can't have trade throughs. So I'm wondering if that's a factor at all, or
Yeah, so that's a good question. I believe your question is, so if there are price differentials across the exchanges, what happens?
right. So in equity markets, you can jump the queue, right? Because there's no time priority across exchanges. So I'm guessing, based on your answer, that mechanism doesn't apply to cryptocurrencies. Okay, thank you.
I don't believe it
That was
does.
my questions.
So
Thank
if
you.
I can just jump in a little bit, because this is an important point. So thank you for your question. So this is essentially one of the reasons why it's really useful to use crypto instead of equities, because as Paige showed that if you have prices being consolidated to a combined tape, as we do in equities, right? And there is a trade-through rule that you can't execute at a worse price if there is a better price at a different exchange. You essentially will have this immediate spillover, right, across exchanges that essentially they're not independent. That even if I split my order, like the prices will update. Where because we don't have that here, you have these uncorrelated prices across venues. So that's essentially the reason why this is useful. A useful
Thanks,
step.
Anne.
Yeah.
Yeah, thank you.
May I ask another clarifying question? So I understand that the trader doesn't have to go and get the best price, but what about liquidity providers, and especially the sophisticated ones? Wouldn't they be watching what happens in one market and immediately transferring that information to all the other markets? Does that not work in crypto?
That's a fair statement, but I think the fact that we do see these wide price differentials across markets suggests that that's not necessarily the case. So Makarov and Shore have a paper where they show that even for Bitcoin, there's large price differentials across these exchanges.
Interesting.
And so I sort of have, I guess, a connected question to that, because my understanding is one reason for that is because you actually have to be present on that exchange, not just quoting, but you actually have to have capital on that exchange because you have to have assets in the custody of the exchange. So in that sense, how easy it is to split my order across the exchanges, because again, as a trader, I would have to be, present on all of these exchanges in order for me to split. So
Yeah.
like the same mechanism seems to be working also in like making it harder to split.
You're right that there's definitely a friction there, and that you have to have capital and funding at each of these exchanges. From some traders that we talk to, it's actually very common to have funding at all these different exchanges, such that we believe that this mechanism is possible. But you're right that that same feature that makes cryptocurrencies beneficial in terms of having these price differentials is also a friction that can, in effect, work against us. We do still find a result in this setting where there is that friction of needing to separately fund each of these exchanges. It's an excellent point.
Joel.
Yeah, thank you. I'd like to amplify that point a bit. Crypto does not have the consolidated trade reporting or consolidated quotes that we're used to having in equities markets. The consolidators are sort of aftermarket entities like CoinGecko, and the speed of consolidation and the accuracy of the consolidation is generally not up to what we would find in an equities market. So you can't immediately switch your orders from one to the other. I'm not even sure you would necessarily know at any particular time which exchange really had the best accessible quote.
Thank you for adding that informative detail.
I guess we're ready to move further and see the results.
Sorry, I just wanted to ask a very quick. So are there market-making entities that provide liquidity in all of these markets? And wouldn't they be aware of all the price movements on all the markets that they provide liquidity in?
That's a fair comment. I'm actually not certain, but I do know that for institutional traders, there are more options available where you can have funding easily set up across exchanges, but I'm not certain about your question specifically.
So you would have to have like an account and funding on the exchange to be a market maker. So for you to observe all the prices in real time, yeah, you would have to do that, because as Joel said, there's no consolidated tape where you can get the information unless you're on the market. So we spoke to a few different market makers and some arb traders as well, and they seem to have funding on multiple different exchanges and are watching price differences between the exchanges to react on that. So it seems that this is the way that people are doing it.
Okay, thank you.
Thanks, Anne. Okay. We'll move forward. So we'll start with the first shock that we're using to fragmentation, which is the collapse of FTX. And I'll come back to the earlier question that was asked about, well, what else is changing when we remove a major venue? So to start, I'll introduce this shock. FTX and FTX US in our setting for centralized cryptocurrency exchanges accounted for over 22% of the trading volume in our sample. And when FTX was shut down, this was a large, sudden shutdown. And here, what this figure is showing you is the average 2-day fragmentation for coins that are traded on FTX and FTX US versus coins that were not traded on FTX at all. And what we're going to be doing is we're going to use the sample of coins that never traded on FTX to build out an appropriate control group such that we can observe what happened when there was a major venue loss versus coins that still were susceptible to the market-wide stress at the time in cryptocurrency, but experienced no such sudden loss in fragmentation. And here again, you can see with the blue line for FTX and FTX US that there was a large reduction in fragmentation at this time, right around the collapse of FTX. Okay, now as was aforementioned, the issue with studying the collapse of FTX is that it occurred in a time with lots of underlying changes in the cryptocurrency market. And so to try to get around this issue, what we're going to do is build a more appropriate control group using a synthetic difference in difference specification. Specifically, we'll be reweighting non-FTX coins on these pre-collapse dates to where they match our treated coins that were traded on FTX on pre-collapse volatility, logged volume, fragmentation as well, so that we can make sure we have a good pre-trend, and the number of underlying venues. And then once we've gone about this matching procedure in the synthetic difference in difference, we also add controls in our regression for logged volume, venue count, and volatility. And then what we're going to do, because FTX is a unique setting where it affected a broad cross-section of coins, is we're able to estimate the effects first, both overall, and secondly, by the coin's pre-collapse share of volume on FTX. Okay, so now up to this point, we've described building the control group. The next thing that we're going to do is exploit differences in exposure to FTX in the pre-period prior to the collapse. And here what we use is the pre-collapse dollar volume share on FTX and on FTX US. Here what this figure is showing you is the effect size for these shocks. So what we're going to do is we're going to bin the size of the shock into FTX volume shares from below 10%, 20%, 30%, and 40%. And here, what this figure is showing you in red, this represents the FTX-sized venue lost. And in blue, this is showing you the equal size venues remaining. And what this means is, for instance, at the 20% volume cutoff, this would be equivalent to like losing 1 of 5 exchanges. Or at the 40% cutoff, this would be equivalent to losing 1 of 2.5 exchanges. If we assume that these, for this simple scenario for illustrating the volume share cutoff, that these are equal sized venues. And so that is to say that at a higher cutoff, there's a larger shock to fragmentation. Okay, so what happened? What we found is that decreasing fragmentation reduces price efficiency. And specifically, as the shock to fragmentation increases, price efficiency falls by even more. So here in this table, we're showing you what happens to the principal component of efficiency. And here for overall, we see that relative to the pre-period mean, here in blue, that overall the efficiency decreased by around 15% of its pre-period mean. And then as we go to higher cutoff bins, so a larger shock to fragmentation, we see that the effect size scales from around 80% of the pre-period mean to about 163% of the pre-period mean for efficiency when we look at this 40% FTX volume cutoff in the pre-period. So that is to say that as the size of the shock to fragmentation increases, price efficiency falls by more. Now, the next question is, what is the mechanism behind this? Does the mechanism appear consistent with order splitting? Okay. And what we find is, indeed, the mechanism appears to be consistent with a reduction in the ability of traders to split their orders across exchanges. Specifically, we find that decreasing fragmentation increases the price impact. So as the shock to fragmentation increases, the price impact increases by more and more. And here again, in red, this is showing you the price impact effect size relative to the pre-period mean, and that it rises with higher and higher FTX exposure from around 32% increase for the overall sample, and then upwards to around 200% at the 40% volume cutoff. Secondly, we test average trade size. So here we can't observe the parent orders. So we do our best to look at average trade size as a proxy for order splitting as well. And we don't find a significant effect here in the FTX shock for trade size. So our expectation was that the average trade size would go up as traders lost their ability to split orders across exchanges. We do find that it increases in magnitude slightly at larger and larger FTX cutoffs. However, it's not statistically significant in this specification, but we do find a large effect for the price impact principal component, which appears consistent with the channel for price impact avoidance. Okay, so that's it for the FTX test. So I'll pause again for questions.
I have a question.
Yep.
And so I was struggling a bit with these principal components. Are you able to tell us price impact is the change in midpoint after a trade?
Yep, that's correct.
So have you done it without taking principal components so that it's a bit easier to interpret economically?
We have done it without principal components. Yes, we've done it both for the price impact as well as for price efficiency, and all of our results go through. You're suggesting it would be easier to interpret economic magnitudes without the principal.
Yeah, what is the economic magnitude here? How much does price impact increase?
Okay, we haven't computed the economic magnitudes off of those, but we have shown that directionally and statistically they all are the same, but that's something we could definitely add. Thank you.
That would be interesting.
Okay, thank you.
Yeah, I'll come back to the question I asked before. So this still seems related. I mean, I like the design very much. Yes, this different, the DID, but those are still exposed. I'm not sure it's a defragmentation or exposure to the FTX, right? Those coins which you're saying were more exposed or more traded there. Maybe there was a shock more for those types of cryptocurrencies. So can you isolate this further, like it's purely segmentation based on your design?
That's a good question. I can't decouple those in this setting. I can tell you what we have tried. So one thing that we've tried is we were worried that perhaps it was an exodus of liquidity providers that was occurring right around this time. So one thing that we tried doing is looking among the coins that were traded on FTX. Did we see like a large exodus immediately? And if we were, right, so if this were driven by an exodus of a liquidity provider, right, you might imagine that the effect would be stronger immediately post-collapse, and then maybe we would pick up more providers in the later period. We don't find results consistent with that, but you're right that in the FTX setting specifically, we can't decouple the effect of losing that exchange itself versus fragmentation specifically. That's a limitation of this test. We'll also add another test looking at Binance, but you're right, like that is something that fundamentally we cannot disentangle. But
did it go down for the control group? Maybe that's a pure test of fragmentation.
Yeah.
Had less exposure, right?
Yeah. The fragmentation did not go down for the control group, or do you mean the outcome variables?
Outcome variables.
Outcome variables. There's a teeny dip. Maybe I jump to. Okay, so we'll look at price impact, for instance, here. And so here in red, I'm showing you the controls, and in blue, I'm showing you the traded coins. And here you can see like a slight bump in price impact, right around like day 5 for the controls. But it's very subtle and kind of goes back closer to its pre-period, versus for the traded coins, this is very high and stays higher.
Right. So the red line is the pure fragmentation effect, in my opinion, at least. But anyway, thank you. Yeah.
Oh, you think the red line is the pure fragmentation effect?
Yeah, because they're not traded at all on FX, or they were?
They're not traded on FTX at all.
Or they're not available at all?
They're not. Yeah. So these
Don't look at something
available.
available there, but not heavily traded there. Right? That would be the more pure fragmentation effect. Anyway, we can take it offline.
Okay. Yeah, I'll have to ask more about it. Thank you.
I had a follow-up to Bjorn's question on just measurement. I guess I'm a bit confused if the idea is that fragmentation causes prices to be kind of uncorrelated or not perfectly correlated. You still need to aggregate those somehow to get, price impact or price efficiency. So I just wasn't clear how you were doing that. And then separately, if you have to aggregate across venues, if you lose a venue all of a sudden, then kind of the aggregation changes. So I'm just hoping for some clarity on how these numbers are calculated.
Yeah. So to go for the aggregation, we start by computing all of these measures at the exchange day level. And then once we have them at the exchange day level, we volume weight up to the coin level so that we're left with one measure across exchanges.
Okay. Thank you. Would it make sense to fix the volumes pre-collapse then, I wonder? Because if you're aggregating, if that's changing after the collapse.
Yeah, so here what we do is we use the volume share for these measures in the month prior to the collapse.
Okay.
You're right, because it would introduce a simultaneous change. Great, thank you.
Thank you.
So I have another kind of connected to the price impact question. One is, was the price impact generally lower on FTX? Because if Alameda was the market maker that was basically kind of cross-subsidized by the exchange's own funds, and like that's why they may have offered favorable conditions, was there anything like just better on FTX? So it's not fragmentation, but FTX specifically. And then kind of the second question is, when FTX collapsed, the coins that were listed there, were they also sort of lost with FTX? Do we have a shock to the supply of these coins in any way, or do you know anything about that?
Yeah. Let me go with your second question first. So how we handle the coin trading specifically is we only focus on coins that were still traded on at least one other exchange post FTX, because we don't want to pick up coins where there's just no more trading in general. So we want these coins to continue to be traded elsewhere, which is what we focus on in our sample. We find these coins in our sample are traded elsewhere. That answers for your second question. And then for your first question, you were asking with the pullout of Alameda, is that driving our price impact result? Is that your question?
Well, like if FTX offered better terms to begin with, and then maybe there was a lower price impact on FTX than when they dropped, and Alameda dropped, like to what extent, I don't think it's going to drive it, but to what extent is it even true? But the trading, I'm not sure if it answered my question, because I'm wondering if you had a large chunk of coins locked on FTX, and then all of a sudden it's just not there anymore. It went down with FTX and we don't have it because FTX owned, like, how do you, like, what happens when, we lost, I lost my funds all of a sudden if I were a market, if I were like, a trader on FTX. And then I don't have access to these funds, kind of, that's my question. Then even for trading elsewhere, it's not like equities where the shares are with a custodian.
I see what you're saying. So you're saying, what if the trader just pulled out of the market entirely? Big, like, right. So what if they, instead of converting their coin elsewhere, what if they just lost this funding on FTX, which did happen for some of the FTX coins?
Kind of, yes, because if FTX had custody of my assets, with them going down, I lost my assets. That's sort of my question. For the coins that were extensively traded on FTX, FTX probably had a lot of them. And so is it true that these coins are kind of just out of circulation, so to speak? So we have like some sort of non-informational but inventory shock to the system. That I think that's what I'm asking.
Yes, that is a legitimate concern, and we do our best by requiring it to trade elsewhere. But yes, to the extent that a trader just lost their funding on FTX, that is problematic. We do try our best with controls to capture this, but there's an element of trader loss that we cannot pick up that is a serious limitation that you bring up.
Anyway, very interesting. Go ahead. Sorry, don't mean to derail.
That's a very big concern. Yeah, that we've been thinking about how to deal with. Thank you. Okay, onward and forward. Okay, I'll keep moving. So the next shock to fragmentation that we're going to look at is when Binance delists a coin. And so here what this figure is showing you is the reduction in fragmentation when Binance delists a coin. So here in this sample, Binance prior to the delisting accounted for over 73% of the volume for the average delisted coin. And again, similar to the FTX sample, we focus on coins that continue trading elsewhere. Here, what this is showing you is the reduction in fragmentation, where fragmentation is about halved around the announcement date. So here, this red line is showing you the day where Binance shows on their website that the coin will be delisted. And then here, around day 6, is when the coin is actually delisted from Binance. And so what we're going to do is we're going to focus on the set of coins that continue trading on other exchanges, but we're no longer trading on Binance specifically. Okay, now again, for this setting, we need to build an appropriate control group. And so for this, what we're going to use is propensity score matching. And we'll use, this is because these are staggered coin level delistings, unlike the fragmentation setting where it occurred at a single event time and affected many of these coins at once. These are staggered coin level delistings. So we're going to be using propensity score matching in this setting. And what we'll do is we'll match each delisted coin to one control coin on pre-period volume, price, volatility, venues, and on fragmentation levels in the pre-period. And then additionally, we'll control for volume, price, volatility, and the venue count. And again, as a reminder here, event date 0 corresponds to the date at which Binance announces the delisting. And then we're going to exclude days 0 from 6 in our setting, right around the announcement period itself, so that we focus on when fragmentation actually decreases and that we're not picking up just that this is a strong negative signal. And I'll show you more how we use these announcement dates in the test after this main test. So here, this is showing you the matched results on the pre-period where we match on volume, price, volatility, number of venues, and fragmentation. Here, this red line is the control group. So these are coins that look comparable in event time to coins that were delisted, that were never actually delisted. And then here in blue, these are the delisted coins themselves. And what you'll see is for price efficiency, right around the delisting date, these coins suffer a deterioration in price efficiency while the control group stays steady. I'll show you the mirror image of this, but for price impact. Here, again, we have the same pre-period matching. In red, this is showing you the control group, which are the set of coins that are traded on, or that are not traded on, not delisted from Binance, whereas blue is showing you these coins that were delisted from Binance and traded on at least one other exchange post-delisting. And here what you can see is this increase in price impact following the delisting. Next, I'll show you this in a formal regression setup. Here, what we find is that lower fragmentation reduces efficiency in this Binance delisting setting. And so here in blue, this shows you the effect for the price efficiency principal component. And what we find is a large decrease in the first principal component for the price efficiency measure post delisting when we compare these delisted coins to a comparable control group pre and post. For price impact, we find an insignificant effect. It's positive, but it's not statistically significant in this setting. In the paper, we do try this with and without controls, and without controls, the price impact is significant, but here once we include controls, it's a bit weaker. And then we find that the average trade size increases. This here is marginally significant, but we find that it increases 55% relative to the pre-period mean. So that is to say that we find that the effect of reduced fragmentation indeed lowers efficiency, and we find some evidence in favor for the channel proposed by Chen and Duffy. Okay. Now, the next question is, are these delistings simply picking up a negative signal, right? If I know that a coin is no longer going to be traded on Binance, is that just a large negative signal for the coin itself? And is that driving this reduction in price efficiency? So we do our best to try to disentangle the effect of the announcement versus the effect of the actual delisting itself. And so if this were simply a negative signaling story, this would predict efficiency would fall on day 0 when Binance announces the delisting. So here, this is when the news is public and trading is available. Whereas a fragmentation story predicts a larger drop after day 7 when Binance trading access is removed here. And so here in these results I just showed you, this is what we're using as the post period. And again, our baseline excludes days 0 to 6 and compares 30 days prior with this period of the post fragmentation shock. So the next question is, if these delistings were just a negative signal, then we might expect that when this is announced, we would see the reduction to price efficiency rather than when the timing maps to the reduction in fragmentation itself. And so to try to tease these two things out, what we're going to do is we're going to compare this period from days 0 to 6 and see if there's any reduction in efficiency occurring here versus the comparison from when the fragmentation shock actually occurs. And we find that our results for the Binance delisting are less consistent with this negative signaling story. So specifically, we find that efficiency falls, and it falls so in a statistically significant way when fragmentation decreases, not merely when the announcement arrives. And so the takeaway here is that the decline in price efficiency is more consistent with the venue loss rather than the negative sentiment of the announcement itself. Okay. So to wrap up these two shocks that we've talked about today and where we've been with the paper is we compared both a market-wide shock to FTX and a Binance shock, which are these routine coin-level shocks in the cryptocurrency setting. And what we found is that efficiency decreased, and we found some evidence for the channel of price impact order avoidance, where we found price impact increase in the FTX setting, and we found a positive but insignificant price impact change in the Binance setting. We also found a slight increase in trade size for the Binance results. And for FTX, we show that the effect size is increased with shock intensity. And so together, these two shocks point toward the same fragmentation mechanism, which is that we show fragmentation can improve price efficiency. Specifically, we find that reductions in fragmentation lower price efficiency, and that the mechanism is largely consistent with a reduction in order splitting. Okay, and now I'm ready for more questions.
I have one. Well, I have probably multiple, but But one is when you talk about delistings, are you talking about the coin delisted or just or a pair delisted? Because for instance, you have this KNC, the Kaiba coin, and KNC ETH delisted from Binance. Was it like just a pair, or was the entire coin delisted? And also my kind of other question is, when they're delisted, where do they go? Because this particular coin, my understanding, is like strongly connected to DeFi. It's like a governance coin for one of the networks, and it continued to trade elsewhere. And so when you're looking at price efficiency, okay, this is gone off Binance, but maybe it's quite efficient elsewhere, and sort of it wasn't really doing that much on Binance anyways. So how do you like deal with all this? It's too many comments, questions in one.
Okay, let's start from the top. So you asked whether they delist a coin pair or whether they delist just say the listing asset. So it can be either. What we did is we actually went through their website. So for instance, they wouldn't delist BTC, but one example would be if they listed BTC, then we would go through and we would say everything that is starts with BTC in our spot pairs would consider delisted. Another thing that they can do, and they do this, is they can also list the specific coin pairing, in which case that specific coin pair would be delisted in our sample. So they have both, and we go through and classify them both using hand-collected announcements from their website. So that's the first question. Okay, and then your second question was, what happens to these coins once they're delisted from Binance? And you asked, do they stop trading in general, or where do they go? I think was your question.
Yeah, well, I'm sure because you look at them continuing to trade, but you look at them continuing to trade on centralized exchanges, but as Binance specifically is such a large one. If it's a like governance coin from DeFi, I'm presuming it's traded on Sushi, Uniswap, and all the decentralized exchanges, and maybe it was primarily traded there. And so, in a sense, how do you deal with the fact that, like, I guess, if it's traded on Binance, it may not be that its major volume was actually on Binance. And so it's not clear to me that the major price discovery, whatever we're discovering, I mean, that's a separate question, what are we discovering, actually happened on Binance to begin with, and definitely probably did not happen on like any other smaller exchange if it's primarily traded not on central. Like I think.
I see.
Yeah,
okay.
So that's kind of my.
Yeah, so we're not using decentralized exchanges in our setting. So to the extent that these coins were more heavily traded by decentralized exchanges, not by Binance in the pre-period, that would be problematic.
But it's a good point. Like we can go and grab some data about like how much these coins are traded on AMMs or anything like that.
Because that also would allow you to have some like differentiation among these coins specifically as well, I think. So if it's like some of them are more affected than others, that might help you with whatever with this.
Thanks, Katja.
Thank you. Great point.
Paige, I'll let you take questions because
okay. Let me pull up so I can make sure I see. Okay, Josh.
Hi, Paige. These are very thought-provoking results, interesting talk. So thanks for that. The one question I had was, if I remember the Chen and Duffy paper, maybe it's been a while since I've looked at it. I think what they're talking about is how informative prices are, and what you're looking at is how efficient prices are. And it seems like maybe those are not exactly the same thing. And I was just wondering if you could comment on the connection there.
Yes, we are specifically looking at deviations from random walks, which is perhaps a slightly different object. We don't have a price informative measure specifically in our paper. And so, yeah, that's something that we could add. Specifically, like maybe we could add something around price discovery. Yeah, that's a good fair point.
Thanks.
Okay. PK?
Oh, okay. Yeah, so I'm wondering about, do you have any ability to get the parent order level data? Because you're saying this is order splitting. But unless you explicitly show, like I was talking a few years back to one of my friends, and he's in this crypto trading. So he said they just sign very specific agreements with the specific exchange, and that's where they trade, all the trades. So they don't really do order splitting, but that's one anecdotal example. So maybe you want to show, because there can be a lot of other things happening on the supply side. You're saying all of it is demand side. Maybe less market, fewer liquidity suppliers, more uncertainty, right? Less market making. Lots of things can go on when exchange goes out.
Yeah, that's fair. I think especially in the FTX setting, like a major concern is what if there are less liquidity providers on the supply side? That is a legitimate concern.
Yeah, I mean, if you have somebody with parent orders willing to give you data, that will actually show up more convincingly, and it is order split.
Okay.
Yeah.
Okay. Thank you. Yeah, Joel?
Yeah, thank you. A couple of questions. First, your efficiency measure, as I understand it, is autocorrelation based, right?
Autocorrelation and variance ratios, yeah.
Right, which is, and they're pretty much measuring the same kind of thing implicitly. And that's really it's speed of market reaction.
Uh-huh.
Ultimately. So, and it's a sensible measure of efficiency, but it is very definitely efficiency. And the other question I had was, what is, you went over this very quickly. I apologize. I hadn't looked at the paper ahead of time. But when you're measuring a panel of price impact measures.
Uh-huh.
Essentially, yes. And what I wanted to ask you about was the component regressions. So, for example, you estimate, you pool your estimate for a given exchange over all of its trades and quote revisions within a particular day, right?
Uh-huh.
So you
Yep.
get a daily measure of price impact. Now,
Yep.
in those individual regressions, sort of the straightforward way to do it would be regress the exchange's quote revision on the exchange's order flow.
Okay. Uh-huh.
Is that what you do?
No, not at the exchange level, because we end up going to the coin level first.
Right, that's what I meant. Yeah, coin exchange.
Yeah. So what we do is we form these price impact measures across the day, pull their principal component, and then what we're doing with the price impact measures is running those in our final regression. And so
Yeah, it was that first level regression that I was asking about, which is essentially you're treating each coin exchange pair as uncorrelated with all the others.
Yes.
That puts a lot of, I think that because your mechanism suggests that order flow is going to be correlated across exchanges by virtue of people doing order splitting, maybe you would want to include some aggregate order flow measures in those regressions.
That's a good idea. Thank you.
It would come closer to capturing, I think, the reality that you seem to be suggesting, which I think is reasonable.
Thank you. Thank you. Those are great comments and suggestions.
Any other comments or questions? No. Oh, this was great. Very interesting talk and paper. Thank you, Paige and Anna.
Thank you so much.
If anybody has any follow-up questions later on, you know where to find them. And also, just once again, a reminder that this is the last talk of the season, but please submit the papers for the next one. And the deadline is June 26th, which is a month from now. And I hope to see you all in the summer, one way or another, not here on Zoom, but maybe elsewhere. Have a nice summer, everyone. And thank you all for coming. See you in September online.